Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing HITI stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. HITI is a cannabis retailer and wholesaler. With the acquisition of Metagrowth a few months ago, it became the #1 cannabis company in terms of revenue in Canada. The company is headquartered in Calgary, Alberta, Canada, and was founded in 2009. It went public in 2018 and trades on the Nasdaq, TSX Venture, and Deutsche Börse. A bulk of its revenue comes from its 87 retail stores across Canada. It has market share in the US and Europe through its online business at the following websites: grasscity.com, smokecartel.com, fabcbd.com, and also cbdcity.com. Its biggest website is Grass City, which had over 100,000 orders in 2020, with 50,000 users and 26 million visits to its website. 3/4 of its visitors are from North America, and it has 290,000 followers on social media. It also designs, manufactures, and distributes products with over 5,000 SKUs. In the first quarter of this year, 4% of its business came from wholesale, the rest from retail. To help increase brand awareness, it has paid celebrities to endorse its products. A few of the names are Snoop Dogg, Cheech and Chong, and Guns N' Roses. The company did a 1-for-15 reverse stock split so it could raise its stock price above $1 to get listed on the Nasdaq. Getting listed on a major exchange gives the company more visibility and potentially may raise its stock price. On the other hand, a higher stock price gives bears more opportunity to short the stock. It's also the first cannabis retailer to trade on a major stock exchange. The future plans for the company to continue growing are by acquiring other companies, expanding to 200 retail stores, implementing drop shipping across all websites, selling Fab CBD products in Canada and Europe. Currently, it's sold only in the US, and once the US legalizes cannabis on a federal level, that will lead to many more opportunities for this company. Also, cannabis companies Aphria and Aurora Cannabis are invested in HITI. Let's get started with the model. This is a small cap company, 385 million market cap. They're trading at $8 a share and they have 48 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 18 and 19, positive in 2020 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative every year. Revenue is the sales for the company, and that grows 12x from 2018 to the trailing 12 months. This is the company's income statement. All their financials are in Canadian dollars. I converted all the numbers to US dollars on my Excel spreadsheet since we're looking at the ticker that trades on the Nasdaq. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that's been growing each year up to 41 million. Below that is operating expenses. Gross profit minus operating expenses gives you your operating income. And that was positive for the first time in 2020. Operating expenses tend to be fixed. So once they pass break even, which it looks like they had, they're going to be more and more profitable as their revenue goes up since they're covering their fixed costs. They paid $9 million of interest on their debt in the trailing 12 months. That's the most they paid. The bottom line of the income statement is their net income, which is negative every year. The reason they had such a big negative was this negative $9 million in other income and expenses. That's mainly from the loss on the sale of a security. But I would focus on operating income when I look at the income statement, not net income. Here's their revenue in the last 5 quarters by region. So you can see in Canada, it grows every quarter and it really jumped up the last quarter. That's due to all the acquisitions it made. In the United States, they had their best quarter in Q3 2020. Then it's been dropping from there. The main reason is there's so much more competition for the US market than the Canadian market. In the international market, they don't have much sales, $200,000 in Q1 2021. Here's a breakdown of their revenue by quarter, and it goes up every single quarter, especially the last quarter really shot up. So they're really doing a great job at growing their business, increasing their revenue, And even though they had negative profit, they are generating positive operating cash flow. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they generated nearly $11 million of operating cash flow in the trailing 12 months. They had their first positive in 2020, negative before that. Then they have a decent amount of CapEx because they need to open up retail stores, and that costs money. They spent $10 million in 2019, but a lot lower in the trailing 12 months. Operating cash flow minus CapEx give you your free cash flow. And since they had negative free cash flow in 2018 and 19, they needed money from somewhere to fund their business. So they generated $4 million when they IPO'd in 2018, and they took on $24 million of debt in 2019. They did add more debt in 2020, but reduced their debt in the trailing 12 months. Now that they have positive free cash flow, it gives them more ability to open up more retail stores, which I know is what they really want to do. That's their bread and butter, and that's how they make the most money. Even if they have to use debt to open up more stores, as long as the stores are profitable, taking on debt is not a problem. Let's look at their capital structure. $41 million of equity, $68 million of debt. They're 37% equity, 63% debt. And their WACC, their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 10.24%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 48 million shares. And we get a calculated stock price of $26. They're trading at $8, so they're trading at a 70% discount. It's a strong buy according to the model. Simply Wall Street is a lot higher than me. They're at 102 a share, so they're saying the stock is 92% undervalued. One analyst priced this stock and their price target was $16. This is the stock price since it started trading on the NASDAQ in January. So you can see the stock was pretty low, around $3-4 a share, and then it shot up to $12, but it's come back down to $8. It's still up a lot in the past 12 months, about 150%. The stock has been trading in Canada since 2018, so you can see the stock was struggling for a few years. In the beginning of this year, with all their acquisitions, the excitement of them getting listed on the NASDAQ and promoted to the TSX Venture, the stock price really shot up in the beginning of the year. It has come down a little since its peak, but it's still trading a lot higher than it was last year. This stock moves with the market. It has a beta pretty close to 1. The stock has gone up 150% in the past 52 weeks, a lot better than S&P 500 at 39%. The 52-week low was $3, the high was $13. It is trading below its 200-day moving average, but slightly above its 50-day moving average. About 300,000 to 400,000 shares are traded each day on this stock. Of the 48 million shares outstanding, 27 million are on float. The other 20 million are held by insiders, mainly the owner of the company. And only 0.5% of the shares are held by institutions. That's a difficulty with stocks like this. A lot of institutions don't want to buy it. And large institutions like hedge funds, mutual funds, and banks, they're the ones who buy most of the stocks. So it does make it difficult for a stock to really go up in price if large entities aren't buying it. In the past 12 months, this stock has done really well, much better than its industry and the market. But in the past 90 days, this stock has gone down 20%, while its industry and the market have gone up. Analysts are expecting their earnings to grow a lot. They're expecting their earnings to grow 137%, while its industry and the market only grow 15%. They're also expecting their revenue to grow a lot more than its industry and the market. In the past 5 years, their annual earnings decreased 48%. That's because their net income is still negative, so it looks pretty volatile. Their industry is up 21% and the market is up 12%. In the last year, though, their earnings increased 27%. The biggest shareholder is the founder and CEO at 13%. He owns 6.5 million shares valued at $51 million. Arthur Kwan, a board member, owns 86,000 shares. Then another board member owns 23,000 shares. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. The average price to sales in the market is 9, the median is 3. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. Their ratio is 4.4, so investors are paying $4.40 for $1 revenue. That's a pretty good price to sales ratio. That's between the market median and average. Their price to book is 9.5. They have $41 million of book value on their balance sheet, but negative $23 million of tangible book value, since they have $78 million of intangible assets on their balance sheet. They just started to become profitable, so their ROIC is only 1%. They cannot cover their interest payments with their operating income, and they have negative ROE since they have negative net income. They can cover 80% of their current liabilities with their current assets, and their current assets are $17 million of cash, $5 million of receivables, and $10 million of inventory. So they do seem to be undercapitalized. They had $5 million of free cash flow in the trailing 12 months and negative $9 million of working capital, so they're short $3 million. But I think their free cash flow is going to be a lot higher in 2021, so I think they'll have enough funding. Although they may need to take on some more debt if they want to acquire some businesses or open up more retail stores. The best way to look at ratios is to compare them to companies in the same industry. For some reason, Yahoo Finance put HITI in the pharmaceutical retailers industry. All the other cannabis companies are in specialty and generic drug manufacturers. So HITI is worse in every single ratio when you compare it to the average, although these companies are a lot different than HITI. To summarize, I have them trading at a 70% discount. Just because a stock is worth more than it's trading at doesn't mean people are willing to pay that price. There's a lot of people out there that just don't want to invest in cannabis companies. And like I said earlier, the large banks and mutual funds don't invest as much in these types of companies. That does make it hard for them to grow. And a lot of investors are concerned the government will try to interfere with these companies and not let them grow that much. But from a strictly business point of view, their financials are really great. Most of the cannabis companies are very profitable and make good money. It's just the government makes it difficult for them to operate. They're always getting penalized and getting taxed really hard. But I think this company is doing a really good job at growing, and if they keep growing at this pace, they may be the leader in the US market also. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.